Hello, everybody. Happy Wednesday, happy July, and a crazy 2020 to you all. Let's do a quick tech check as we get started. Somewhere probably over here, you'll see a chat. I know a couple people have already typed some things in. There's question boxes down at the bottom. It's a very exciting platform. First, let's just do a tech check. Let me know, can you see me? Can you hear me? You can just say yes in the chat or let me know who you are, where you're coming from. I know we've got our solo 401k clients from all 50 states and probably about a dozen countries. So just let me know that you can hear me and you can see me. Type, yes, I can hear you, or here, I'm joining you from wherever you happen to be so that I know it's going great. Okay, awesome. Hey, thanks. Okay. Cool. All right. Yeah, good to see some names we've known for a long time. Some new people too. First webinar, rock on. Welcome, Kevin. Yeah, we will have the replay available. We'll send that out tomorrow for everyone. That way, in case you can't stick around for the whole thing, this should be a pretty short webinar. We're going to be really laser focused on the CARES Act, but we will email you guys a replay tomorrow. In case you don't know me, I'm Rachel Neighbors, and welcome to our CARES Act webinar. So, all right, let's see here one moment. All right. Hey, thanks everyone. Great. Okay, so I have a presentation that I've prepared for you. So the first thing that I'm going to go ahead and do is share my screen with you so that we can go over this presentation and dig in a little bit together about the CARES Act and specifically how it is affecting your solo 401k. All right. So give me one moment here to work my computer magic. Okay, and now you should be able to see my screen. So, Solo 401k and the CARES Act. Of course, a disclaimer as we jump into the materials here. This is not tax, legal, and investment advice, even though we're talking about the law. If you have questions about how these CARES Act provisions relate specifically to your Solo 401k, always engage your CPA, tax professional, or legal counsel. So today we will discuss the CARES Act and how it affects your solo 401k plan. We'll also cover how to take a distribution or a loan if that's needed. And a great place to start is, what is the CARES Act? On March 27th, 2020, Congress passed the Coronavirus Aid, Relief, and Economic Security Act, and the president signed the act into law. This groundbreaking piece of legislation dramatically altered how we think about and access our retirement funds. Now, there's a lot in the CARES Act. Most people know about retirement plan distributions, waiving RMDs, and the temporary suspension of early withdrawal penalties, and we'll get to those in a second. But let's discuss what else is included in the CARES Act, because there's a lot. Several provisions were understandably about healthcare. These provisions are meant to provide support to those affected by the pandemic and our nation as a whole. Some of these healthcare provisions include $130 billion allocated to hospitals, adding personal protective equipment to the Strategic National Stockpile, providing grants for those researching COVID-19, and providing further grants for the development of telehealth. And this last one is particularly interesting as we move from the industrial age into the information age. Everyone's going online. We are all here together online. You probably met us online. So this expansion into telehealth is also very interesting. The economic relief to businesses was monumental as well. $500 billion was granted in the Economic Stabilization Fund, and these were meant for big businesses like, the Boeing bailout, for example. $669 billion went to small businesses in the Paycheck Protection Program. We've written a lot of blog posts and released information about the Paycheck Protection Program since literally every single solo 401k client is a small business owner. So this may have affected you. And the CARES Act also expands the SBA, that's the Small Business Association, Economic Injury Disaster Loans, also known as their EIDL program. Additionally, the government tried to take care of regular taxpayers too, in the form of increased unemployment benefits, and this is sorely needed as we have reached 45 million Americans unemployed and counting. And also, the relief might have come in the form of stimulus checks for eligible families. But one of the most groundbreaking parts of the legislation was how taxpayers are allowed to access their retirement funds and defer taxes if you are taking a loan or a distribution. One example of this is that required minimum distributions, also known as RMDs, are suspended for 2020. This is aimed to help reduce taxes for those in their golden years. And I want to take a pause here just for a moment. We have a lot of articles that we've released and prepared for you in the Solo 401k knowledge base. You can find this specifically at support.solo401k.com. We've tackled each area of the CARES Act as it relates to retirement plans, be it required minimum distributions, loan provisions, distributions, extended contribution deadlines because of the tax day being pulled back or pushed back to July 15th. So definitely make sure that you are bookmarking support.solo401k.com so that you can easily access the client knowledge base anytime you need it. There's more provisions that we're going to cover about the CARES Act, but first, I want to give an important disclaimer. You must qualify to access these provisions. The Solo 401k that we created for you allows you to self-certify, and this means there are no delays if you need to access your retirement funds. I have a little video here on the screen of an easy way for you to access the self-certification form. From your 401k dashboard, just click on Forms and Coronavirus-related distribution. You can access that form 24/7. So if you have been affected by the coronavirus and need to take one of these distributions, it's very easy for you to access the self-certification form from your online Solo 401k dashboard anytime you need it. You'll simply download that coronavirus-related distribution self-certification form, print the form, sign it, and store the signed self-certification form in your Solo 401k records. On that form, you will have to certify one of any option of things. So some of the options are for self-certification that you have been diagnosed with the virus SARS-CoV-2 or the disease COVID-19. Alternatively, you might have had a spouse or dependent diagnosed with COVID-19. Or you can self-certify that you have experienced financial hardship as a result of being quarantined, furloughed, laid off, experiencing reduced work hours to COVID-19, or an inability to work due to lack of childcare due to COVID-19. Additionally, you can self-certify you've experienced financial hardship as a result of having to close your business, maybe even temporarily due to COVID-19, or that you have experienced reduced hours of your business operation due to COVID-19. Now, a reality check, many Americans, if not all, have been adversely economically affected by the coronavirus pandemic. This has affected all of us. However, we don't recommend that you utilize the following provisions unless you can actually legitimize that you needed to access the funds due to hardship related to COVID-19. This legislation is incredibly new. IRS guidance is still developing. Could the government try to go after people who said they needed funds from their retirement plan and really didn't? Yes, they can. So please proceed thoughtfully. There are two ways you can get access to your solo 401k funds and retirement funds in general through the CARES Act. The first is through loans, and the second is distributions. First, let's cover how participant loans for the 401k are affected under the CARES Act. There are two main provisions as part of the CARES Act. One is an increase in the amounts used to determine the maximum allowable loan amount. And the second is a delay in repayment for new and existing loans. So one thing that's very interesting about the CARES Act is you are able to double your loan amount. Under the CARES Act, you can take out up to 100% or $100,000 from your 401k funds, whichever is less. This is double the normal amount of a participant loan. One very attractive feature about the solo 401k is the ability to take a loan from your 401k to yourself. This is the tax-free participant loan. Under normal circumstances, that loan amount is 50% or $50,000, whichever is less. Under the CARES Act, those provisions are doubled. So you can take out 100% or up to $100,000 of your 401k funds, again, whichever is less. And you can delay your loan repayments one extra year. So remember, the whole point of the CARES Act, the reason why the government included this legislation or the retirement account provisions in this legislation is a lot of people have a lot of their money in retirement plans. So in a state of total economic uncertainty, a lot of economic turmoil, the government knew they had to let people tap into their retirement funds somehow and more than usual. And because we don't know how long this thing is going to last, also they're trying to delay or defer taxes, loan repayments, penalties, things like that. Because I mean, the fact of the matter is they don't want an entire nation of completely unemployed and people who are really with their backs up even more against the wall. Now, one thing that's really important to note here on the time frame for this expanded loan is that these expanded loans, this 100% or $100,000, must be initiated between March 27th, 2020 and September 22nd, 2020. Today is July 1st. So that means you have about 2.5 months to take this loan if you need it. If you think you'll be taking the expanded participant loan under the CARES Act with those special provisions, add a notification to your calendar or your iPhone or your wall calendar, get the big red Sharpie and make a circle around that date. That is the deadline for this expanded provision. If it's September 23rd and you're taking money out of the 401k via a participant loan, you're back to those normal provisions of 50% or $50,000. Additionally, there's some loan repayment changes. New or existing participant loan repayments from March 27th, 2020 through December 31st, 2020 can be delayed by a year. Loan repayments will restart with any payments due on or after January 1st, 2021. The skipped payments and any interest that accrued on those skipped payments must be repaid starting on the 1-year anniversary of the first skipped payment. When your loan repayments restart, your repayment amount is adjusted to account for the missed interest. And maximum repayment period is extended by the time frame in which the payments were skipped. And sometimes this stuff can be kind of heady. So retirement accounts are a little weird. Let's just look at examples wherever we can when it comes to actually having the rubber meet the road on this stuff. So let's imagine you're taking a $75,000 loan from your solo 401k on August 1st, so a month from today. You start paying the loan back on August 1st, 2021, and those repayments will have principal plus the accrued interest on the skipped payments for those skipped payments over that year. We have an expanded loan template for you. You can locate this template in the knowledge base. Again, that's at support.solo401k.com. And it's quite easy to locate that loan template. The easiest thing to do is you'll log in to your 401k dashboard, and then you want to click on support in the upper right-hand corner, which takes you to the knowledge base. Type in loans in the search bar, scroll down, and go to the coronavirus related loan provisions. And then we have a template at the bottom. So again, support, click on the support link, go to the knowledge base, find the coronavirus related loan provision article, and then we have a template that's right there for you. Again, you can access these loan templates and applications 24/7. I've had a couple people ask me if it's okay to just go through the normal loan provision or the normal loan procedure on your 401k dashboard. We don't have that expanded capability right now. We're trying to see if we can program it in, but allowing for all of the different iterations, all of the different amounts up to that expanded $100,000, and being able to delay loan repayments up to 1 year. It takes a lot of coding. I don't know if we'll have that available before the deadline. So that's why we wanted to make sure that you have this template available to you 24/7. It's totally fine to complete this loan template and then to do the loan like normal, write the check from the 401k to yourself, and work with your CPA to determine your amortization schedule. And we are working with our programmers if there's a way for us to be able to get that coded into your 401k dashboard where we can have the coronavirus loan provision as an option. Of course, we'll let you know, but definitely utilize this loan application and promissory note template that we have available already for you right now through the client knowledge base, which you can get to from the support link on your 401k dashboard. Another feature of the CARES Act that I want to dig into just briefly is the ability to waive early withdrawal penalties. So typically, if you're going to take money out of your 401k plan and you're under age 59 and a half, the IRS wants to ding you with an extra 10% early withdrawal penalty. During the coronavirus pandemic, if you're doing these distributions anytime before the end of the year, then that early withdrawal penalty is waived. So again, this is all meant to help taxpayers access their retirement funds if they truly need them without getting dinged with extra penalties or fees or taxes. So if you do need to take an early withdrawal or a distribution from your 401k plan and you're under age 59 and a half, complete the self-certification form and you can waive the early withdrawal penalty. And then, of course, always work with your CPA to make sure that any required filings are done appropriately. Truthfully, we're still waiting on guidance from the IRS. This whole thing has unfolded so quickly, and there's been so many moving parts. The government is not known for its efficiency. So we are still, every week getting updated guidance from the IRS on how we're supposed to be charting things. And if any of you have taken the PPP loan, that's the Paycheck Protection Program loan, you've probably seen that literally every week, the SBA is releasing new guidance and then flexible guidance and then updated guidance. And they said this past Monday that we got the final application and final guidance. So we'll see how long that sticks. But, the government's just trying to respond to this pandemic. So they're kind of putting stuff together with duct tape at this point. So, okay, the early withdrawal penalty, though, the ability to waive that early withdrawal penalty is another way they're trying to help taxpayers to not be hit so hard economically with the slowdown that's resulted from the pandemic. So probably one of the most popular aspects of the CARES Act, and certainly one of the most publicized and how it affects retirement plans, is the distribution clause. You can take out up to $100,000 from your retirement plan as a distribution. This is not a loan, and you have a couple of options on how you put the funds back or pay taxes on the withdrawal. If you were adversely affected by the COVID-19 pandemic, this may provide a way for you to get access to your retirement funds. And remember, if you are under age 59 and a half and you need to take this distribution, you will not pay early withdrawal penalties on the funds you remove from the retirement plan. And this withdrawal applies to both 401k plans and IRAs. So remember, the participant loan is only available to 401k plans. If you have a checkbook IRA with us and not a solo 401k, you can still take the $100,000 distribution from your checkbook IRA. Once you take the funds out of the retirement plan, you have a couple of options. So you can distribute up to $100,000 from your plan and choose to either pay the taxes on the distribution over 3 years or return the funds to the plan within 3 years and pay no taxes. And again, retirement accounts are a little bit weird. So let's go over a real life example. Let's imagine you're an interior design consultant. Understandably, your business revenues have reduced dramatically due to the COVID-19 pandemic. You decide to distribute $100,000 from your solo 401k plan so you can pay your bills and get through the next few months of lower revenues. You would go on to your 401k dashboard, access that coronavirus related distribution form, fill it out, sign it, and then distribute the funds. You'll, just like a participant loan or any other time you are withdrawing funds from your 401k plan, as you know, with the solo 401k, we make it really easy. Write a check or send a wire from your solo 401k trust bank account to yourself. Here's something that's important, guys. The funds must go directly to your personal bank account. They cannot go into your business bank account. Remember, with these distributions and participant loans, the funds go to the participant. So that's you as a natural person. That means that when you're writing the check or sending the wire from your 401k trust bank account, it needs to go into your personal bank account, cannot go into your business bank account, because this is a personal distribution from your retirement plan. And then once you've distributed the funds, you can decide how you want to proceed. Option 1 is put the money back within 3 years, pay no taxes, and replace the $100,000 into your solo 401k trust bank account. Option number 2 is pay taxes on the distribution. If you don't think you can pay the $100,000 back, then you can spread out the taxes that you owe over a 3-year time period. So let's imagine you're at the 20% tax bracket. You would otherwise owe $20,000 on your $100,000 withdrawal. Instead of having to pay an extra $20,000 in taxes on your 2020 filing, you have 3 years to spread out your tax payments. And that would mean about $6,667 due with your 2020 filing, your 2021 filing, and your 2022 filing. And again, the whole point here is the IRS is trying to do what they can to help people out. If you need access to your retirement funds, instead of smacking you with a huge tax bill because you had to take a distribution, they're trying to soften the blow by letting you repay pay those taxes over 3 years. Now, here's something that's interesting. Once you make a distribution from a retirement plan, you can return those funds to another retirement plan. And this makes sense, right? If you have 3 years, let's say you're working for company A right now and you have a regular 401k with them, and you are able to take a CARES Act distribution, also known as an in-service distribution, but it's under these special provisions. And then let's say in mid-2021, you stop working for company A. Well, you're not going to put the money back into that same company retirement plan if you don't work there anymore. So that means that you can put the money back after you've distributed it into a new retirement plan, maybe for company B, or maybe for your solo 401k. This means this distribution and being able to put funds back into another retirement plan, this means that if you can take an in-service distribution from your current employer, and I know for a lot of our clients, you might still work a regular job, have a regular 401k, and in other circumstances, you would have not been able to access these funds. They don't allow in-service distributions. If you can legitimize that you qualify for a CARES Act distribution, you can take the funds out of your current employer 401k plan and put them into your solo 401k. This is an eligible rollover distribution. And I just want to repeat what I said because I know it's a little bit of a mind melter for some people. If you're otherwise not able to take money out of your current employer 401k plan, right? They have your money locked away in 401k prison. But because of the CARES Act, they're letting you take some of that money out. There's nothing in the law that says you have to return the funds to the same retirement plan you took them out of, which means that you can put the money back into a different retirement plan. In this case, this might be a way to get money from a current employer plan into your solo 401k. Now, of course, I will still strongly recommend you got to legitimize this thing. You have to truly need the CARES Act distribution. You self-certify, at least for the solo 401k, you self-certify so you can make that decision on your own. I wouldn't just use it as a way to game the system. I don't think that's a good idea because this is still the law. It's still legislation under IRS rule. So don't game the system. But if you can truly legitimize that you need access to these funds, and it's more advantageous to you to put the funds back into something like a solo 401k or a checkbook IRA that you control, then that option is available to you. Okay. So now let's kind of look at the flow of how you take a coronavirus distribution. It should be pretty self-explanatory. You guys are all used to your solo 401k. You're used to being in control. You are used to being the plan administrator and keeping great records of your solo 401k. So this is really just going to be an extension of that. The first thing you'll do is download, complete, and sign the self-certification form. We've already covered it's very easy to find that self-certification form right on your 401k dashboard. You just click on the drop-down link for forms and then select coronavirus-related distribution, download, complete, and sign that form. Store it in a safe place. You don't have to send the form back to us. You are your own plan administrator. Step 2, wire the funds. Send the funds from your 401k trust bank account to your personal bank account. Remember, do not send the funds to your business bank account. Send them to yourself personally as the plan participant. Step number 3, make a repayment plan. Decide if you're going to put the funds back into the retirement plan within 3 years or pay taxes on the distribution. And this is specifically, guys, for talking about the distribution, not the loan. So I'm talking about specifically here if you're actually distributing funds. It's not the loan. Not going to plan to pay them back. Over the 5 or 6 year time period. You're really making the decision of you're just keeping the money out and paying the taxes, or you're putting the money back within 3 years. Because remember, those are two options. One is a distribution and one is a loan. And then step 4, keep good records, just like you're already doing with your checkbook IRA and your solo 401k. If you are repaying the distribution, keep records of your repayments. If you've done this as a loan, keep records of your loan repayments and always involve your CPA so they can help, check your math, make sure that everything is being filed correctly. We probably don't really need to go over this, but the steps to complete that self-certification form are download it, complete it, print and sign and store in a safe place. You do not need to send the completed form back to Neighbors Group. If you like to upload a copy of it to your dashboard, just so that your 401k dashboard, just so that you know where it is at all times, then that's certainly something that you can do, but you do not need to send it back to Neighbors Group. And that self-certification form is really easy. You're literally just putting in your name as the plan participant, choosing one of the check boxes of how you are self-certifying. Either you have been diagnosed with COVID, you have a spouse that's been diagnosed, or you meet one of the economic hardship qualifications: furlough, laid off, reduced work hours, inability to operate the business at the same capacity as before, et cetera, et cetera. It's pretty straightforward. So download that form, complete it, print it, sign it, store it in a safe place, take the funds, give them to yourself, and then let your CPA know what your plan is for the distribution, if it's to repay the money or if it is to pay the taxes over the next 3 years. And just normal stuff when it comes to the solo 401k. If you take a coronavirus related distribution from your solo 401k plan, and also if you take the loan, always keep good records. Involve your CPA so they can help, especially if you're paying taxes on the distribution over 3 years. And the reason why I'm really harping on this is because, as I mentioned, it's very, very new legislation. We are always, we're constantly getting updates from the IRS on how they want us to document things. We're writing the amendments so that they can be included officially as a part of your plan documents. They'll be in there probably next year with the rate that the IRS takes to get back to us and let us know if the language that we're using is appropriately or is appropriate. So a lot of this stuff is going to continue to unfold over the next few years. I know some of us might be kind of over the pandemic. We're frustrated or bored or just dealing with the fallout of this pandemic. The administrative and bureaucratic delays are going to be even more intense, you guys. So just be aware that the government they kind of did like a ready, fire, aim, right? They wrote this law to try to let people have access to their retirement funds because they needed them. And now they're kind of, sweeping up behind the broken vase, trying to figure out how to put the pieces in place so that everything is documented correctly. Of course, as we get guidance and updates from the IRS, we will always keep you informed and let you know if there's any, new forms or filings that need to be completed. But this is the information that we have right now. So just in closing here, why to take the funds? If you truly need access to your retirement funds due to economic hardship, consider this CARES Act distribution. The government has unlocked access to your retirement funds really in the first time in recent history, certainly for the first time in the last couple of decades. There have been economic disaster hardship amendments and ways that you can, avoid the early withdrawal penalty in previous times, or you can kind of take some money out if you were in a disaster location. This happened with Katrina, for example. If you were affected by Katrina, you were able to take funds out. But we've never had anything that's this widespread. And I'm talking about not just the virus, but the legislation. We've never had such broad legislation when it comes to letting people access their retirement funds. So this truly is groundbreaking, and it's there for a reason. So a couple fast facts just before we finish up here. The distributions must be taken before December 31st, 2020. Okay, there's a time limit on this. And remember, the loan, if you're going to do the expanded loan provision, must happen before September 22nd. So write those dates down. September 22nd is the last day you can take a participant loan with the doubled amounts. And December 31st, 2020 is the last day that you can take the distribution. So you got to know about those dates. Your distribution cannot exceed $100,000 or your vested account balance, whichever is less. And you can't double dip. You can't do a $100,000 distribution and a $100,000 loan at the same time. That $100,000 is per taxpayer. So if you already have a $50,000 loan that's out, you can't take another $100,000, right? You can't exceed $100,000. That's the magic number across all of your distributions, your loans, pre-existing, new. That's the way that the IRS is looking at it. They're going to let you have $100,000 total for all of your distributions and your loans across this whole thing. And to avoid taxes on your distribution, if you are going to take the money out, you have 3 years starting from the day following the day the distribution was received. So again, if we use sort of a real life example, today is July 1st. If you completed your self-certification form today and you wire the funds from your 401k bank account tomorrow, that would be July 2nd, right? Today is the 1st, right? Yes. Okay. July 1st. So that would mean you receive the funds on July 2nd. That means you have to put the money back or pay taxes by July 3rd, 2022. Let me repeat that because I know that's like math. So today is July 1st. You send the wire and receive the funds tomorrow, July 2nd, 2020. That means in 3 years from the day after the distribution is July 3rd, 2022. Your money better be back in your solo 401k by July 3rd, 2022, or you have the taxes, have some sort of a tax plan going by that time. Now, I want to bring up something interesting here. Let me go ahead and sort of put myself back on the camera for a moment, because this is when I want to actually talk to you guys about this stuff. Hold on. Let me see if I can make it work. Can you see me? Am I back? I think yes. Just tell me yes if you can see me. So here's something I want to talk about that I think is really important when it comes to how this whole thing works with calendars. Sometimes banks are closed the day before or the day after a holiday. So that would mean, and you're right. Sorry, guys, you're right. 2023. Don't make me do math, especially not on a live webinar. 2023. Thank you, Doug. Thank you, Stephen. 2023. So, but let's talk about calendars, because especially right now, going into July 4th, this is something that definitely affects how you're going to be timing things. So some banks are closed on July 3rd or July 5th. You want to look at that date and really go and flip through the calendar and see what the date falls on July 3rd, 2023, if that was the date that you were actually going to be doing your distribution. Because if the bank is closed or the wire doesn't come in on July 3rd, then that's it. That's your cutoff. You missed the deadline. Now that's a for real taxable distribution, or you're delinquent in paying your taxes. Same with your participant loan. You really want to make sure that you are planning and projecting a little bit, looking at calendars. Does July 3rd fall on a Sunday? Then that means you need to have the funds in by July 2nd. This is, I know it seems kind of like nitpicky stuff, but it really does matter. So when it comes to the IRS, this is just stuff we don't want to mess around with. Okay, so I think that I'm almost done with my little slides here. Let me just check and see if we have any more to go over, and then we'll open it up for questions and stuff. Yes. Okay. So final slide. Have a webinar suggestion? Let us know. We want to talk to you guys about, we wanted to do this webinar today because it was really important and timely to make sure that we are talking about the CARES Act, the coronavirus related distributions, especially with the September 22nd deadline. It's going to be upon us, faster than we might imagine. So we wanted to do today's webinar. I know it can be a little bit dry talking about the law and stuff like that, but it's really important that we go over these types of nuts and bolts for how you're using the solo 401k. We have some really fun webinars coming up throughout the summer where we're going to be discussing investing in various things. Farmland, we'll have non-recourse lenders coming on to do Q&As with us and talk to us about how they decide how to write mortgages for investment properties in the 401k. We have some CPAs that are going to come on and teach us about contributions and really maximizing how we can make our contributions in the solo 401k, different tax strategies. We have attorneys that are going to come on and tell us about prohibited transactions and surviving an audit. So there's a lot of really cool stuff that we have coming up this summer and into the fall as far as our webinar series for our clients. If you have suggestions on topics that you want us to cover, just email us, call us, send us a message. Let us know what you would like us to cover. Because we're solo401k.com, we can get some pretty awesome speakers. So we have some fun stuff lined up for you coming into the fall. So, all right, I know that we have some questions that people have put into the chat. I had someone email me questions earlier, and we've also got questions down below. So, all right, let's do the first question here from Rajan. Under the CARES Act, are there any penalties or tax implications for taking out a $100,000 loan from the solo 401k? So, Rajan, I'm going to answer this question as best as I can, of course, with the disclaimer that we can't give tax, legal, or investment advice. Your situation is highly personal. Always work with your CPA. And the reason why I kind of give that disclaimer is the answer, are there any tax implications, is probably not. But it depends. So are there any penalties for doing the $100,000 loan? No, there are no penalties for taking the loan. Participant loans are tax-free, which means that you're not adding that $100,000 onto your income tax for the year. You're just allowed to take that money out of the 401k plan, and then you start repaying that loan. So far, we don't have any guidance on from the IRS that the interest rate is any different. So right now it should be the prime rate plus 1%, just like a normal participant loan that you would take. And that means that your prime rate right now, I think that when I checked it earlier this week, it was 3.25% plus 1%. Your participant loan interest rate is 4.25%. We don't have any other knowledge from the IRS that it's going to change. So we are operating under the assumption that this $100,000 loan that you can take from the 401k plan, you're going to be using that same prime rate plus 1% repayment interest repayment rate. So there's no tax penalties, no implications for taking the loan. Just make sure that you are working with your CPA so that you're paying the loan back on time. If you miss loan repayments or if you just don't pay the loan, then there are tax implications. It's a distribution, and now you owe taxes on that $100,000. So great question. Work with your CPA, and yeah, you should be good for that one, Rajan. Okay, next question comes from Lisa. Do you have to take the loan and wire the funds on the same day? No, you don't. It's probably a good idea to do them pretty close together just so that your documentation is lining up with the bank wire, but the exact same day, no, that's not necessary. So for example, if today is the day you're wanting to fill out the loan paperwork and you do the wire tomorrow, that's fine. You can also fill out the loan paperwork and then just choose to sign it and trigger the loan when you actually take the funds. So remember, that paperwork is just for you internally. You can print it, print it out, get it all ready, work with your CPA to have your loan repayment schedule, and then just actually trigger the loan. What triggers it is when you're actually taking the money out of the 401k plan. So great question, Lisa. Okay, Russell says, so the only difference with the CARES Act loan would be that you can borrow 100% or up to $100,000 rather than the normal 50% limit. Yes, and you can also delay your loan repayments by 1 year. So it really means that you have 6 years to pay the loan back rather than 5 years. Now, you have to pay interest on those skipped payments. So you might choose to take the $100,000 or 100% loan and not delay repayments. You have a lot of flexibility here in the way that you're going to work this thing. Of course, talk with your CPA. You don't have to delay those loan repayments. Really, what the government is trying to do is give as much latitude and as much leeway as possible because it's a pandemic. So they want people to be able to access their retirement funds and have as much economic flexibility as they can provide. Okay. Next question from Steven. If I'm thinking about taking either the loan or the distribution, and I plan on paying back the distribution, is it true that the only difference is the 5-year or 3-year payback period, respectively? Great question. So the answer is yes, sort of. If you take a loan, you have to make repayments of principal plus interest. So you can't skip the interest payments. If you just take the distribution, then there are no interest repayments. It's just the principal amount. You're putting the money back within 3 years. So I think the question really becomes, if you're looking at your strategy, short, mid, long-term strategy, what are you trying to accomplish? Do you want to get a little bit of extra money into the solo 401k? Do you have extra money that's available where you can pay that interest payment on top of the principal repayment? Or are you kind of strapped for cash or not interested in doing the loan, in which case the distribution might make more sense? So the differences between the two are, on the surface, just the repayment period, 3 years versus 5 years. But remember, with the loan, you've got more time to have that money in your possession. But when you're paying it back, you have to also account for paying back the interest and the principal on the loan. And just as a refresher for everybody, when it comes to participant loans, you can't make interest-only payments. The IRS says you have to do substantial and equal principal plus interest payments. So they want to see things amortized out over time, where you're paying interest and principal on every payment. Our plan documents for you will create a monthly repayment schedule, but you can do as infrequently as quarterly. It's up to you. Work with your CPA, make sure you're running the numbers so that you can see what makes the most sense for you. Great question, Stephen. Now I have a question that was emailed in earlier. Let me pull it up here. So Daniel said, I'm a full-time employee, and in addition to that, I have a small business. I currently have $100,000 in the solo 401k, and I've already taken out $50,000 in loans. My business brings in about $10,000 a year. Would I be able to take out $100,000 even though I have not lost any time or money as an employee or an owner? This is a great question. And this comes back to that whole self-certification thing. And really, there's a couple of questions and things I want to address in your question, Daniel. So first, remember we said that $100,000, that's total. That's an aggregate amount. So Daniel, if you've already taken out $50,000 as a participant loan from your solo 401k, you have $50,000 to work with. You can't take out another 100 because that would put you at 150. That's it's over the maximum allowable amount from any single individual taxpayer participant in a retirement plan. So question number one that I'll answer here is if you have already taken out a $50,000 loan, then you would be able to take another $50,000 loan. But the second part of your question is what I really want to address, because you said, I have not lost any time or money as an employee or as an owner. So this is a gray area, right, guys? I mean, I don't know anyone that has not been somewhat adversely affected by the pandemic. The economy essentially ground to a halt. We had some of the biggest losses in market history in March. Somehow, magically, the real estate market is strong, but most pundits are saying and economists are saying that that might not hold over the next year. We just don't know. We don't know what's going to happen as a result of, tons of unemployment and people being in lockdown for several months. So it's challenging. It's a gray area because we've all been in some way adversely affected by this global pandemic and resulting economic shutdown. But if you say that you have lost no money, no revenue, everything has continued along just fine, hunky-dory, pandemic or no pandemic hasn't affected you whatsoever, I would be hesitant to take that loan, only because, as I mentioned, the legislation is new. And could the IRS try to make an example out of some people? Yeah, they could. Will they? Probably not. It would be very, very, very unpopular to go after hardworking Americans who needed to tap into their retirement account during an unprecedented global pandemic. I think the chances of them going after someone are really small. As solo401k.com and a document provider, do I need to let you know that that's an option that they could go after you? Yes, I need to let you know that they could. They could try to make an example out of someone. So that's why I said it's important to proceed thoughtfully and, talk things over with your CPA, maybe even family legal counsel. And as we continue to get more guidance from the IRS, we'll keep you guys updated on that. So thank you, Daniel, for emailing that question in. Okay, Stephen has another question. Let's jump into that. If I take either a distribution or a loan and find out that I don't need as much money as I thought, can I put the additional money back without any early repayment penalties, like depositing a lump sum back into the solo 401k? Yes, you can. With the participant loan, there are no early prepayment penalties. There are no prepayment penalties if you put the money from a distribution back within the before the 3-year time frame. If you take the money out and 6 months later, you're able to put it back. There's no prepayment penalties. You don't have to keep the money out for 3 years or anything like that. You have a lot of freedom and flexibility. But again, this is going to be different rules for distribution versus loan. So if you take the distribution out and you find that you don't need that much money, can you just put it back? Yes. If you take the loan out and you want to do a lump sum or a big chunk repayment, you can do that, but you still have to be calculating the interest that would otherwise be tabulated on that loan. So remember, loans and distributions are two different animals because of the way that the repayments are calculated with interest. So it's important to sit down and have a think on, if you are taking money out of the retirement plan, which structure makes the most sense to you. If it makes more sense to do the distribution and pay the taxes, do the distribution and put the money back, or take the loan and then do principal plus interest repayments. Okay, so I think we saw, okay, there's a couple questions. So Mark said, discuss allowable special withdrawal from the 401k program and what can that be used to fund? Can it fund a portion of a new business venture? So yes, once you take the distribution or the participant loan, that's your money. You can choose to invest it in anything that you want. And I kind of have two answers here, one as a business owner and then one as solo401k.com and as a document provider, right? So as solo401k.com and a document provider, I think that legitimizing any distribution is critical. You need to be able to self-certify truthfully and accurately to the IRS if they ever asked and that you needed those funds for some reason. Now, as a business owner, I could argue that maybe you do need those funds as cash infusion for your business to be able to keep the cash flows going while you're running your business. Or perhaps you could fund a new business venture that would bring in profits that would allow you to make the distribution repayments more quickly or ensure that the loan repayments can happen. It's a really big gray area when it comes to that stuff. So, Mark, I can't tell you definitively, yes, you can use those funds to put into a new business venture. But what I can tell you is when you take those funds, they're yours. So you get to make a decision on how you want to use those funds. That's your call as the plan participant. And I think more important is just really being able to legitimize that you needed access to the funds in the first place. Okay. I got another one here. It's from Doug. Discuss the RMD requirements for 2020 and how long do these new requirements run for? So I actually have a link I'll put in our chat that you can see here. This is a link right, I think it went through. I hope it came through. It went right to our knowledge base. If you guys click on that, I hope it won't make you leave the webinar. So I hope it didn't just break anything there. But I basically gave a link to an article that we wrote on required minimum distributions specifically, and the solo 401k and coronavirus. So you can get all of the questions answered there. You basically have the ability to defer them for a year, for this entire year. Okay, let's see. Next, we've got Kevin. Does the self-certification form work if I distribute from the employment 401k and pay myself back from my solo 401k? Fabulous question. The self-certification form is specifically for your solo 401k. So if you need to take money out of your employer 401k plan, you need to do two things. You want to ask, first of all, have you adopted the CARES Act? That kind of tells them you know what you're talking about and you know that there's retirement plan provisions in there that allow you to take these distributions. So ask them, have you adopted the CARES Act and distribution provisions for retirement plans? Because they'll say, yes, of course we have, or no, we haven't. And then if they say, no, we haven't, you can probably tell them, like, you should really consider adopting this. A lot of people are having economic hardship right now. It's sort of silly to not let them have access to their retirement funds. But I digress. If they have adopted the CARES Act, then that means that they're going to let you do the same things that the solo 401k will let you do. Because remember, the solo 401k is just a regular 401k, but it's shrunk down small for your small business. So we follow the same rules under the solo 401k that your corporate employer 401k is following. The CARES Act rules are the same for all of us. It's just that sometimes employer 401k plans don't let you have a loan, and the solo 401k does. Or employer 401k plans don't let you take CARES Act distributions, and the solo 401k does. So Kevin, what I would do is ask your employer, have you adopted the CARES Act? And if they say yes, then you can let them know, okay, I would like to see the certification form, please. I might need to take the distribution. And then they will be able to walk you through their process. What we've gone over today is specific to your solo 401k with us and how you take money out of the solo 401k specifically, and the proper procedures and guidelines to go through in removing funds from the solo 401k. So your employer 401k is going to have their own certification form, and they're going to have their own rules. It should still be the $100,000 as far as 3 years paying it back or doing the taxes. All that's actually part of the law, but not all employers have adopted the CARES Act, which I think is kind of ridiculous. But that would be the first thing to ask them. Have they adopted the CARES Act? And if so, what is their certification procedure so that you can take the loan? All right. So, Gil. Hi, Rachel. I am over 70. I'm taking RMDs. Do I understand correctly? I can postpone the taxes for 2 years. Okay, let me go ahead. I'm going to share my screen again, and let me show you guys this. One moment. I have to click the special buttons. Hold on. I want to do this so that you're not seeing, my face within my face within my face, and we go into a wormhole. So let's try this. All right. So now you are seeing our article in the knowledge base specifically about required minimum distributions. So can the solo 401k waive the 2020 RMD requirements? Yes. What that means is if you would otherwise have been paying RMDs or taking RMDs this year and then paying those taxes, you can skip them for this year. If you already took your RMD, you can put the money back as long as you took it less than 60 days ago. So I've linked to this in our chat, but Gil, I would recommend that you want to take a look at that article from the knowledge base. I think that will be really helpful in answering your questions about avoiding or waiving RMDs for 2020. All right, Shankar says, my wife and I are partners in a business and have a solo 401k. Can I take $100,000 under my name and $100,000 under my wife's name? Can I use the money towards new rental property purchases? All right, so again, there's a couple of questions here that I want to address. So Shankar, if you have $100,000 in the solo 401k, then you can take the distribution for yourself as a participant of the $100,000. If your wife is going to take the distribution as well, she needs to also have at least $100,000 in the solo 401k plan. So remember, the solo 401k, is at the company level, and you and your wife are each participants in the company retirement plan. So you guys are all great plan administrators. I know you're keeping good records of your solo 401k plan. So Shankar, you know how much money in there is yours, and you know how much money is your wife's. And it's coming from rollovers or contributions, but you have a clear record of whose money is whose. So you take your distribution based on what you have in your portion of the solo 401k. And your wife takes her distribution based on what she has in the solo 401k. Shankar, if you have $300,000 in the solo 401k and your wife has $10, you can take $100,000 because that's your distribution as the participant. You can't take out money for yourself, but in her name. Now, the second part of your question, can I use the money towards a new rental property purchase? This kind of goes back to a similar question to like what Mark was asking. Can you use the funds to, pay into a new business venture? And again, I'll give the same answer. So as an IRS approved document provider, solo401k.com, I would say you need to definitely legitimize that the distribution is necessary, that it's required. If the IRS came and knocking, they wanted to know what was going on, why did you take this distribution, you would have a good response for them. It needs to be a truthful and accurate reason that you're taking the funds out. And once you remove the funds, they're yours. You are the participant and you're able to use those funds as you choose. Could it be argued that in using the funds to purchase a rental property, you created an income stream so you were able to repay the distribution? Probably yes. But again, is this guidance still developing from the IRS because this is so very, very new? Also yes. So use your discretion, talk with your CPA, and be thoughtful about what you're going to do and how you're accessing your retirement funds. Okay, we're almost to the end of our time here, guys. So I'm just going to look real quick and see if we have any other questions. Okay, Lisa says, do I need to have assets liquidated before taking a loan or distribution? Like, can I take a loan and then figure out what to liquidate and then go through that process after the loan or distribution date? So yeah, sure, technically you probably could, but I think that in keeping excellent records and books for your 401k plan, you already know what's in your 401k. So you know what your plan value is because you know what the assets are that are in the 401k. So from there, I would say that would be the real steps, right? Look at your books, look at your records for the 401k plan, know what you've got in there. And then make your determination of how much of the distribution or loan you need. Fill out the self-certification form. And then if you need to divest or liquidate assets to be able to remove the cash, then you could do that. Okay, we got a couple more questions here, and then we will call it for the day. Doug says, can I take a loan under the current interest rate that's currently lower than current loans? Repay the current loans and no issue. So when you're taking a participant loan from the 401k plan, Doug, you're going to use the prime rate plus 1%. As of today, the prime rate is 3.25. So that means your participant loan interest rate is 4.25%. If you're taking the loan today, then that's the interest rate that you're going to use on your repayments. And sure, I mean, if you have other loans that are out there at a higher interest rate, you can take the participant loan at the lower interest rate, repay those higher interest rate loans, and then be making the repayments back to your solo 401k plan. Okay, let's see. Can you put a link to the new form for a loan? Yes, I will put the link to the new form for you guys here. Give me one moment. And then we'll do one last call for questions. And also do let us know if you want to type into the chat. Let us know other topics that you would like us to cover on upcoming webinars. As I mentioned, we're going to be discussing different investment types. We've taught a lot over the years on real estate and Bitcoin and gold and silver. We'll continue to dive into those topics over the summer, expanding into talking about farmland, non-recourse loans, CPAs, attorneys, surviving an audit, all that good stuff. Let us know what you'd like us to cover so that we can really help to make using the 401k fun and profitable. And yeah, just keep us posted, guys. We are here to help, especially during the pandemic, but always. So if you need us, lean on us. That's what we're here for. And have an awesome rest of your day. Stay safe, and we'll talk to you soon.